Hi, and welcome along to this supplemental podcast. What I'm going to try and do is step through the process for detecting solvency, essentially based on financial statements. So to do that, I've put together a single slide, and we're going to use the case from Class BC Venice Cloth. What I want you to do when you think about this is to understand that there's not one way to do this. You can do the steps in different order. People would even maybe look at some subtly different things, but this is a way to look at it. The second thing I want to emphasize is that it's not just about looking at the financial statements. This is very important, and it is very important that you understand this. But similarly, there are other things that you might need to look at, and we touch on that in one of the steps, but I'll come back to that and re-emphasize it. So let's go on. What does the one slide approach to detecting solvency look like? In essence, I think that there's 4 key steps that you need to take. There are some subsets within that. There are things you look for, so you look at things in the statement, you're looking for what's going on in the company, and you're trying to draw some conclusions, or at least to understand what information you need to know in more detail. So let's get into it. Let's look at step 1. And in step 1, I want us to look at the cash flows. I'm looking at the cash flow because solvency is about being able to pay your debts as and when they fall due, which requires you to be liquid to have cash. So let's start at the cash flows. As I said before, though, some people don't start there. They might look at the balance sheet first, or even the profit and loss. But I think a good path is to look at cash flow, and it reminds us about solvency being about liquidity. So here we are, and we've got our financial statements. You can see that on the top is whether we're profitable or not, which is looking at profit and loss, ostensibly the accounting versions of profit and loss. Below that we have a balance sheet, which might have some different headings and subheadings depending upon the classification system that the company uses. And this third one is the one that I'm really interested at first, the statement of cash flows, and it goes again back to liquidity and issues of liquidity. So the first thing I actually want to look at is cash flow from operating activities, and these are listed here. Okay. So you can see across here we have how much revenue is coming in. If you don't have any statement of revenue or in the profit and loss, this is a fairly good approximation. The revenue from operations that is cash. It's not quite the same as revenue because accounts receivable mightn't be in it, and some other accruals, etc., might not be in it, or so it might be understated a little, or overstated if we've collected a lot of cash from the year before. I won't go into those details. It's a good approximation. So this is the cash we've got coming in. This is the cash we've got going out to our payments to suppliers and employers, and money going out to pay interest and tax, and then we're left with the net cash position. This is a really important number because it tells us how much cash our operations are making or losing. And when we look at this, we see it's bad, and it's bad generally, negative 8,000, well, negative 7,800. But it's also bad in the sense of a trend. We've gone from negative 1,850 to negative 7,800. Now if we just take a quick look at the trends, so you notice I'm looking at absolute values and trends at the same time. If you look at these values, we can see that the payments to suppliers and employers are increasing out of proportion to our revenue from operations. This is a big point because it seems to say that the more we sell, the more we seem to lose. So not only are we burning cash, but we're also burning cash faster as we speed up, as we increase sales. Not a good spot to be in. The other thing that you might want to do to hit now is to work out how much cash we're burning that per month, and that can come in useful to give us an idea about how long we can possibly survive into the future if we are approaching insolvency. And to do that, you have to make a number of assumptions, which are really tenuous. In the real world, you would have to check these assumptions out before you could go forward. But for our purposes, let's look at this. Look, we've got negative 7,800. So what we could do is we could go to our calculator and we could look at 7,800, right? That's how much we're losing a year from our operations. And if we divide that by 12 months in the year, it says we're burning 650 cash each month from our operations. So if things are stable and if our cash burn rate isn't increasing, and remember, the trend is that it looks like it is increasing and increasing greatly, but if it weren't, and if we burnt the same amount each month and continued that trend into the future, we would need 650 cash. Notice up here now, 620 cash is what we have. We'll come back to that. So we've worked out our cash burn and our cash burn rate. I'm then going to go and look at our financing activities. Okay, our financing activities are through here. We can see them. Why is that important? Remember, being able to pay your debts as and when they fall due isn't just about what's going on operations. It also relies on whether or not you can access equity and or debt. If you can access equity and or debt, then you can pay your debts as and when they fall due, irrespective of what's going on in operations. So now I start looking at the finance activities, and I see that we've raised a lot of equity. We've also raised a lot of debt over the particular period. That has implications for whether we might be able to raise it into the future. It also explains why our cash flow in the previous year was positive. Like we've got negative cash flow from operations, but a positive overall cash flow. Why? Because we raised money from finance. Similarly, we had negative 7,800 from operations, but only a negative 3,300. Why? We raised all this debt. So the only reason our cash flow and our assets appear better than what they really are, than what they would be, is that we've raised debt and equity. Okay, the other thing that we would want to look at is investing activities, what's going on there. I'm assuming that these funds are being used to purchase the acquisition, etc. in the case. Assumption that would need to be tested in the real world. Assumption that would need to be tested is, is this the limit of what I could possibly raise? An assumption around my cash flows here is, was this in the plan or not? Given the facts in this case, I don't think it was in the plan. I think that's a reasonable conclusion to make. But if it was in the plan that we were going to lose this cash, then things aren't as bad as if it's unplanned, which I think is the case here. So we've done step one now. Okay, we've reviewed the cash flow, operations, finance, and investing. We're burning cash. In fact, we're burning cash around $650 a month. Most of our cash that we've been able to raise has come from equity and debt, not operations, and the trends are overall negative. So we're unlikely to be able to raise cash. I can't see any unusual investments in there, but the acquisition doesn't look positive. Okay, so we've got an idea about where the cash is coming from. Now we need to see what we owe and what we own. And to do that, we're going to look at the balance sheet. So we're going to look at the balance sheet, and in A, we're going to look at the current assets, then the current liabilities, and then look for any potential non-current things going on. So let's go in there. So now we move up to the balance sheet. Okay. Now you'll remember before when I'm looking at cash flows, I said we're burning $650 a month in cash. We've only got $620 in cash according to our financial statements. That means we have less than a month if things continue at the same rate and nothing changes. And that's assuming that these figures are current and up to date as of now. So it says, we need to be able to get cash from something else. What else can we quickly turn into cash to pay our debts? Well, one thing that we can use are accounts receivable, the amount that people owe us and that gets paid in the short term. Now you can see here, a positive is that there's been no real increase, no real substantive increase. It's gone up from 4,600 to 4,800. Okay, minor increase, but look at the increase that we've had in sales, in cash coming in from our operations. That would suggest that if cash coming in went up so much, wouldn't we expect a proportional increase in our accounts receivable? Here we don't see it. That's good in one way. It means we're keeping on top of our accounts. It's potentially bad in another though, because what it says is our ability to, for want of a better term, squeeze our customers or to try and induce payment earlier is decreased. We're probably already doing that, and we're probably getting all the cash in that we possibly can. Well, let's move on to our third item here, which is inventory. 9,300 to 15,100. Oh, well, that looks potentially a negative thing, right? Because it's gone up so much. Looks like we've got inventory there that we might not be able to realise. Again, look at the trend though. 16,009 on 16 is roughly the same as 15 on 27. So proportionally, our inventory hasn't risen that much. A lot of our cash has gone into making this inventory. And if we were to move on to the next step, which is looking at some ratios, what we'll see is that our liquidity problem or our solvency doesn't look too bad from a ratio perspective. I'll come back to that, and we'll set the groundwork by talking a bit about realisability now. In order for ratios to be useful, and in order for us to interpret these figures, inventory and accounts receivable, we do have to know whether or not these figures are realisable. What that means is sometimes, for instance with accounts receivable, we can list customers who owe us money when they're not going to pay us. And we probably know they're not going to pay us. But if we keep them in there, our liquidity looks better. That's a problem because we're never going to get the money, and it's unrealistic, and they shouldn't be in there. So one of the things that you need to look at when you're looking at financial statements is whether any of that's going on, whether we're not writing off debts we should. The second thing we need to know is inventory. Is inventory realisable? Can we actually get 15,000 for it? One thing that companies do is they can manufacture stuff or make stuff or buy stuff thinking that it's going to be sold, and it's not, and they're going to have to discount it. So they're in no way going to get this 15,000 for it. It's very hard to make an absolute judgment on matters such as these. You have to understand the figures in the nature of the business. Here, in this business, we're dealing with clothing. Clothing is fashionable, and it is also can be seasonal. Okay, so we've got two good reasons to say, geez, we wouldn't want to really be holding a lot of stock. We also think about ointments. They can date. The bandage type that they have may well date. We don't know. We would need to understand that in more detail, but it looks prima facie, or at first instance, like we don't want to be holding a lot of stock. How much stock do we hold? Well, a rough way is to think we sell 27,000 in a year, and we've got 15,000 worth of stock. So at its full value, what are we dealing with? 15,000 divided through by 27,000 equals 0.55. So that's 55% of the year, 12 months in the year. We've got nearly 7 months worth of stock. That's a lot. That is a lot of stock to be carrying for things that might be out of season, that might be dating. So we start to go, that's questionable. Okay, let's move on from current accounts and look at current liabilities. Again, not much of an uptake here. If things are going badly, you might see the current liabilities shoot up because we're not paying suppliers. So that's a key sign of insolvency approaching that we don't actually see in this particular case. So that's positive. Also in terms of a positive, it means that there might be an ability to actually lengthen our terms with some of our suppliers to provide a bit more working capital if we need it. You know, if you really think hard though, and I don't want you to overthink this, but if you really think hard, if suppliers think that you're in trouble and that you're having solvency and operational problems, they may actually not be giving you the terms that you had in the past. So again, the fact that this is coming down when all of our sales are going up could be a sign our suppliers are onto us and that they're trying to get their money quickly and not be exposed to their position or their debt with us. Okay, so we've looked at the current assets and current liabilities. Now the idea is, right, current assets is what we own in the short term, current liabilities is what we owe in the short term. If we have more of what we own than what we owe in the short term, we can pay our debts as and when they fall due. So that's why people look at the current ratio. They have current assets divided by, right, current liabilities. Now in both these instances we've got high ratios and it actually looks, right, so we've got 4 into 10, which is about 2.5. 4 into 13 is almost 3, right? So we're getting a better ratio. Oh, sorry, I'm looking at the wrong one. 4 into 17 goes about 4 times. 4 into 20 goes about 5 times. So our ratio is getting better. But remember, that ratio is dependent really heavily on this inventory. And that's where the quick ratio comes in. The quick ratio is more conservative and it takes inventory out. Why does it take inventory out? For a couple of reasons. Why your inventory may be impaired or non-realizable. That's just a fancy way of saying you can't get what you say it's worth for it when you sell it. Or secondly, you can't sell all your inventory, right? You need some in the supply channel. So counting it as part of your solvency is wrong. Let's take it out and get a conservative estimate. So then this goes from about 8,500 to 5,400. And our ratio drops from roughly 2, which is this 4,200 into this 8,500. Okay, it drops down to just above 1, which is 5,400 divided through by 4,300. So you can see our quick ratio. Now we're saying, oops, we're approaching solvency, and that we really need to be careful, and that we've got this problem with inventory, which I've discussed a lot. We can also start to look at some non-current assets and liabilities to make sure that they are what they say that they are. There's nothing untoward in our particular sheet here. So if we go back to our stage, we can now see this trending down in liquidity that we have. We can see that the cash is going into what appears to be inventory, and so the inventory becomes a critical component of our decision making here. Our ratio analysis reinforces that. There's no real irregular balance sheet items that we can see. So we have questions about realizability of our accounts receivable, and also about our inventory in particular. We have adverse trends in our cash holdings. And prima facie, we're solvent, but just, depending upon a number of assumptions. So now we might want to look in terms of profitability. I don't want to overemphasize this for our course. Of course, you would look at this in more detail in the real world, but let's just roughly have a look at our profit and loss. And it reinforces what we've seen in our cash flow and our balance sheet. And we can see our net operating profit after tax is negative. But notice what we do see here is a reason why we use cash flows is that our position in 03 is not nearly as proportionally negative to 2002. I mean, they're roughly equal as what our true operating cash flow position says. So that's one of the reasons why we're looking at cash rather than profitability. You can hide some stuff in profitability, and you can make things look not as bad as what they truly are. It also shows that overall we've lost money in this company if we had have invested in it. In terms of a potential bright side, if we're going to look at profitability and profit and loss, we can go down to our segment information here. And what we can see is that in terms of our original business, right, we've remained profitable. It's in the other areas of business, in the clothing and in the other medical, where we've lost a lot of money. That's based upon a lot of assumptions, including things about allocations of overheads. If you don't know what I'm talking about, don't worry. Just know that there's a number of assumptions behind that statement, but it can be useful in developing a course of action forward. So we've now gone through all of the major elements of looking at our financial statements. I also should emphasize you need to be able to understand the relationships between particularly the cash flow and the balance sheet, and that will help you understand how people can make figures look better than what they truly are. So if I want to increase my cash, I can get my customers to pay earlier, but that means on my balance sheet my accounts payable go down. If I want my cash to go up, I can decrease the inventory that I hold, but that could affect operations and my ability to supply. So cash could go up, but inventory would go down, and I might also see some non-financial issues around supplying customers. If I wanted cash to go up, what else could I do? I could not pay my suppliers, and my accounts payable would go up. So there are these relationships which it's important to understand. As well as that, we need to look for the non-financial signs of trouble. Some of those non-financial signs of trouble include the elements of, or the possible warning signs that were set out in the water wheel case. Now, I didn't label this in our lecture slides originally, so the water wheel case points are, you can see now on the screen. It comes from our session 4 slides. And these are signs that you might not see in your balance sheet. So if there's fraud or if there's something untoward happening around the categorization or the use of the numbers in the firm, you need to be aware that these things are red flags, and you need to be on your toes if you see any of them. The final thing you want to look at is anything that could turn any of our non-current liabilities current. Why? All of our ratios and things have been done around current or things due in the next 12 months. However, debt, when we take out a loan, often comes with things called debt covenants or a promise. So we promise that our liquidity ratio won't go below a certain level, and if it does, then the debt becomes due and payable. That's really important, particularly in a situation like this. We probably have breached debt covenants, and we saw that through the GFC in 2009, etc., where people were breaching debt covenants. What happens? The full, large, non-current debt becomes due and payable, and the company can't refinance. And if it can't refinance and the debt's due and payable, it's insolvent. So, very important to understand that. On the upside, we need to understand if we can raise more money from anyone or any source in particular. So at the conclusion of that, you should know, can you trust management? Do you know the full frank position of all of your debt and all of your equity? Are there any of these major pluses or minuses in terms of major debt or equity that we haven't looked at yet that could affect us? At the end of all that, you need to make a decision. Are you solvent or not? What's your realistic ability to trade out, etc.? So I hope that that's been helpful, and give me a hoy or drop me an email if there's anything further I can do.